I'd like to thank everybody for joining me today. Today, I want to talk about an important topic, and that's how we structure the owner and beneficiaries of a life insurance policy. I think we spend so much time talking about the life insurance design itself that we don't stop and think, what else should we be doing to make sure we have proper ownership and that the beneficiary structure is the way we want it. If you look at life insurance, there's so many reasons why we buy life insurance, whether it's for tax planning, estate planning, retirement planning, business planning, using it for the living benefits, creating cash value for what if. All of these things and all of these different areas of planning are tied together with life insurance, because life insurance is such a unique leverage tool. It's also a very unique planning tool because of its income tax and estate tax features. Now, if you think about it, if we take all that time for this planning and don't get the ownership and beneficiary correct, well, did we accomplish what we needed to? So when you start thinking this through, think about each scenario. So let's take a look at the ownership. If we have a business and we're doing a buy-sell agreement, well, the owner can be the business. And we've just recently seen that if you've got a buy-sell and that is run through the business as a redemption agreement, there's some extra steps you need to take in the estate planning world to make sure it's effective. Also, we can have a cross-purchase agreement and have that buy-sell life insurance owned by each owner of the company. There again, it can be held inside or outside. Where do you want it to be? If we have a key person insurance policy, well, that needs to be owned by the business. If you think about it, if we have a CEO that we want to protect the company, if there is an unfortunate death, disability, those types of issues, we need that money coming into the business. Therefore, the owner of the business should be owner of that policy should be the business, and that's going to be an asset of the business, and it's going to show up on the balance sheet for the business. It's also going to be a footnote in their financial statements. Now, when we get into executive benefits, this is where we have to take a little bit of time, because that policy can be owned by the business. It could be owned by the key executive. Most of that's going to come into what type of plan we're setting up. And if we're creating tax deductions for the company, then it's going to be owned by the individual. As they recognize income, then that's going to be deductible to the company. There again, on the business side, we just want to think through what should it look like. On the personal side, we have the estate planning issue. Do we want this policy in the estate or out of the estate? Well, if we want it out of the estate, in most cases, mom and dad cannot be the owners of that policy. Now, we can hold it in an irrevocable trust. We can have the owners be the kids. There again, mom and dad don't own that policy. We don't want them to have what the tax code refers to as incidents of ownership either. They can't control that policy, or it's going to be brought back into the estate. If we're doing this for income replacement, typically if we're doing this for income replacement, let's say the wife is working and wants to provide income replacement to the husband and children. Okay, in that case, the wife could be the owner of her own policy. She's the owner, she's the insured. That would be okay. We're not worried about, is it part of the estate? We're using this to provide income replacement. There again, go back up. If you want it outside of the estate, then we need to look at an irrevocable trust as the owner, or we can have, in that case, the spouse or the kids be the owners. If we're looking at this for living benefits, especially the chronic illness rider, the long-term care riders, now we have to make sure that we understand who the owner of that policy is. Typically, we're going to look at the insured being the owner of the policy. That's okay. Now, if we want it outside of the estate and we want access to living benefits, well, the owner can be an irrevocable life insurance trust, but we have to make sure we're using the right kind of policy, and we'll talk about that on other calls. Finally, if we're using this for cash value access, think about this. If you want access to that policy, the only person entitled to access is the owner of the policy. So if I want access to a policy on my life, I better be the owner. If I want that access inside of an irrevocable trust, the irrevocable trust will be the owner and the trustee can access that policy. So there again, think about what we're trying to accomplish and make sure that the owner of that policy fits the planning. Now, if we look at the next issue, it's who's going to be the beneficiary. Now, we've discussed who the owner of the policy is. Now let's look at the beneficiary. If it's a buy-sell agreement, well, the beneficiary better be the individual or the company responsible for that purchase when the buy-sell agreement is triggered. There again, if it's a redemption agreement, the company better be the beneficiary of that policy. If it's cross-purchase, each owner would be the beneficiary on each other's policy. There again, if there's a death, the money ends up in the right hands to make sure that happens. If it's a key person, there again, we said the owner's the business. The beneficiary is going to be the business as well, because we want the money flowing into the business so the business has the liquidity to go replace that individual that's been lost. Executive benefits, there again, this can go all over the place. If typically the beneficiary is going to be either the executive or the executive's family, depending on how we structure that. Now, remember, we can have split benefits here. So there's a lot of times we'll set up an executive benefits policy, but it'll also be treated somewhat like a key person. So maybe the beneficiary for part of it is the business, the other part is the executive's family or heirs or whoever they want to personally name. So there again, we just want to be careful. On the estate planning, if we want it outside of the estate, the beneficiary cannot be directly mom and dad. And if we want it, if we're using irrevocable trust, the irrevocable trust should be the owner of the policy and the beneficiary of the policy. That way it's outside of the estate and the proceeds stay outside of the estate. I've seen mistakes made where they've gone to the effort of setting up an irrevocable trust. They put the policy in the trust so the ownership is correct, and they named a spouse as the beneficiary. So they've done 2/3 good planning, and the final third phase blew up all the prior planning. So there again, make sure it's in the right spot. If it's income replacement, there again, do we want it in the trust and part of and outside of the estate, or do we care? Can we have spouses, be as beneficiaries so they have access to that money for income replacement? Living benefits, ownership probably matters a little bit more here than the beneficiary, but there again, we're not just planning in a vacuum. We want to make sure if that policy's for living benefits, ownership is correct. But if they don't ever use up the benefits of that policy, that the death benefit beneficiary goes either to spouse, kids, or wherever it needs to go. Finally, on a cash value access policy, we're building it for what if. There again, the owner has the rights to access that cash value during life. The owner is the one that's going to have access. The beneficiary is going to receive whatever's left. So think through, there again, we talk about life insurance being a Swiss Army knife of planning. Well, this is part of what that can be. Yes, our primary purpose is cash value. Our primary purpose is living benefits. Our primary purpose is income replacement. What's our secondary purpose? And there again, make sure the beneficiary matches up to where we want it to go. So if you think through this, we're building this puzzle. And once we start building this puzzle to meet our clients' goals and needs, as we start putting this puzzle together, life insurance is typically a big part of this. This is where we need to stop, take a breath, and say, who should own this policy and why? Who should be the beneficiary and why? Remember, a lot of these things last a long period of time. So not only the primary beneficiary, but what about the contingent beneficiary? Especially if we're naming a trust, the contingent beneficiary is not as big of an issue. But if we're naming individuals, well, if the primary person passes away, who does that policy go to so we don't end up in an unnecessary probate that could have been avoided? I appreciate everybody getting on today. If you have questions about this, feel free to reach out and we'll talk again next week. Thank you.